Hello everyone, welcome back. My name is Arias, and today we're going to be going over how I value Latch. I will give examples of a couple different ways I value Latch, and then wrap it up with the price target and takeaways. Before we get into it, for a deep dive on the business itself, check out my previous video on Latch. That will be the first link in the description. Don't forget to like and subscribe if you enjoy this type of content, and leave any video suggestions and feedback in the comments below. And without further ado, let's get into it. This slide here is projections put out by Latch for their finances going forward out to 2025. For our first two projections, we are going to focus on Latch's annual recurring revenue, or ARR, which Latch projects to grow to $644 million per year in 2025. Now you may be wondering why we're just looking at the software revenue segment, and specifically how much recurring software revenue they will have. And that's for a few reasons. As you will notice on this slide, the hardware business will be just barely becoming profitable at this time. If I were Latch, and they have said that they are thinking the same way, I would run this part of the business at break-even to get as much of their hardware out there, installed in as many doors as possible, which they can then earn highly valuable software revenue, as well as use to expand their user base, which they can then further monetize in other ways. It also builds out some cushion for projections if they do run the hardware business at a profit. As for why I'm looking at just ARR and not booked or net software revenue, I think it smooths out all of the lumps that can come with large booking deals and massive apartment owners, and gives a pure look at how well the software business is doing. On this slide, we will make projections based off the price to sales ratio surrounding this booked ARR. First, let's try to make some projections based off the estimated 2025 numbers that they have published. They estimated their booked ARR to be $644 million in 2025. Now the question is, what is an appropriate price to sales ratio for this metric? I put together a list of companies in the bottom right to help us understand this. Each of these companies can be thought of as a typical SaaS company, providing an extremely sticky software product on a recurring revenue basis. Interestingly, Latch might be even stickier than these businesses, as the cost to install and then remove Latch's hardware, combined with a long 6-year contract, will make switching a losing proposition for most of Latch's customers. Latch's software revenue will have extremely high gross margins as well, which will be similar to these companies. Latch is also projecting 52% growth in booked ARR from 2024 to 2025, which is close to the top of all these companies. So how will we value Latch? To be conservative, I've applied PS ratios of 20 and 15, which are on the lower end of these companies, even though Latch is growing faster than most of them. A 20 PS ratio would yield a valuation of $12.88 billion in 2025, representing a 6.6x from today's market cap of $1.92 billion and a 60% compound annual growth rate over the next 4 years. A 15 PS ratio would yield a valuation of $9.66 billion in 2025, a 5.9x gain, and a 50% compound annual growth rate over the next 4 years. If either of these results come to fruition, this would obviously be a huge return in a very short amount of time. Moving on to 2031 projections, I used a flat 25% compound annual growth rate from 2025 to 2031, as they are growing into a huge market that they are only projecting to be 3% penetrated in 2025. This 25% growth rate could be considered somewhat conservative, as it would be a drastic slowdown from the 52% growth from the year prior. This would yield a booked ARR of $2.45 billion in 2031. If we lower the PS ratio 5 points each to account for the lower growth at that time, a PS ratio of 15 would give a $36.75 billion company, a 19x gain, and a CAGR of 34%. A PS ratio of 15 would yield a $24.5 billion company, a 12.7x gain, and a CAGR of 28%. These would all be crazy returns that I'd be extremely satisfied with, even though you can make a cogent argument that I'm being conservative here. One last thing on this slide, in my previous Latch video, I made some revenue projections out to 2031 that end with $3.79 billion in total revenue, including hardware. The profitability of this revenue will be diluted as hardware is included and they won't be growing as fast, so I brought the PS ratio down to 7. This would still imply a $26 billion company, a 13.6x gain from here, and nearly a 30% CAGR over the next 10 years. Another phenomenal return, albeit lower than the other ones presented. I hope y'all are starting to see why I think the risk, which is obviously larger than with most companies, is well worth the reward with Latch. Now let's make some projections using the same booked ARR numbers, but this time valuing them using a PE ratio. I don't really like the 2025 projections because they will not have this level of profitability yet in 2025, as they will still be spending heavily on R&D and sales and marketing to grow at the max rate. Putting that aside and using their theoretical profitability, I used a 40% profit margin on this pure software revenue, as they have recently stated they expect to get a 90% gross margin on this revenue. This may be a bit aggressive, especially for this time in Latch's development, so I also used a 30% profit margin. I also used 30 and 40 PE ratios, which as you can see from the companies listed at the bottom right hand corner are very conservative for a company growing revenues that fast. A 40% profit margin and a 40 PE ratio off of $644 million in booked ARR would yield a $10.3 billion company, a 5.3x gain from today, and a 51% CAGR over the next 4 years. Moving on, a 30% margin and a 30 PE ratio off $644 million in booked ARR would yield a $5.8 billion company, a 3x gain from today, and a 31% CAGR over the next 4 years, both of which are very good returns. Moving on to 2031, if we use the same 25% CAGR of booked ARR out to 2031 as we did on the previous slide, we would again get $2.45 billion in booked annual recurring revenue in 2031. If we value the company using the same profitability and valuation metrics as before, which I think are now a bit more accurate considering Latch will be more mature while still being a high growth company, they will not be growing as fast as they previously were, so they will deserve a lower multiple, a 40% margin, and a 40 PE ratio off $2.45 billion in booked ARR would yield a $39.2 billion company, a ridiculous 20.3x gain from today, and a 35% CAGR over the next 10 years. A 30% profit margin and a 30 PE ratio off $2.45 billion in booked ARR would yield a $22 billion company, an 11x gain from today, and 27% CAGR over the next 10 years. Yet again, these will both be awesome returns that anyone should be more than happy with. Lastly, we'll make some more projections using the previous video's revenue numbers. The profitability of this revenue will be diluted as the hardware will be included, so I brought the net profit margin down to 20. I also brought the PE ratio down to 25, as these projections only have them growing 20% in 2031, and the hardware revenue is not as valuable as the other software revenue alone. This would still imply nearly a $19 billion company, a 9.8x from here, and a 25% CAGR over the next 10 years. Another phenomenal return. Now we are going to move on to the final way that I value Latch, and that is based off total units booked. I expect this metric to keep growing and will be another good way to cut through the noise and lumpiness that can come with looking at this business. These estimates will be done by projecting out units and the average revenue per unit, and then using these numbers to get a revenue figure and then valuing the company based off that. To give you an idea for how large this market is, Latch estimates the American market to be 47 million units and the European market to be 93 million units, with a total yearly market value of over $100 billion. So this is clearly a huge market that they're projecting to only be 3% penetrated in by 2025. Latch is currently in 1 of every 10 new constructions in the States, and I would only expect this to increase as we go forward. Additionally, Latch said at a recent event that buildings are renovated or change hands about every 10 years on average, and this could be considered the in-year TAM. 1/10 of 140 million is 14 million units a year as in-year TAM, which is much larger than their projected 2024 to 2025 growth of 1 million units total. For the unit projections, I assumed the growth rate would drop from 40% from 2025 to 26 to 25%, which is considerably slower than the 64% CAGR from 2020 to 2025. This would give 15.8 million units in 2031. Now to project the average revenue per unit, where Latch currently gets $7 to $12 per month per unit. They also said that they have a clear view to 150% revenue growth with just the products that they have currently launched or have in the pipeline to launch in 2021. For 2025, we can determine their approximate estimated average revenue per unit, or ARPU, that they are projecting of about $14.50 by dividing booked ARR by cumulative booked home units. That would give 11.5% growth each year from the approximately $8.50 that they had in 2020 by the same calculation. If we assume that this growth rate slows modestly to a 10% CAGR in ARPU from 2025 to 2031, we would get an average revenue per home unit of $25.70 per month. $25.70 times 12 months is $308 a year per unit. If we take $308 per unit and multiply it by 15.8 million units in 2031, that would yield $4.87 billion in 2031 revenue, which is the highest number we have valued them based off so far, and this still does not include any contribution from hardware revenue, meaning this is pure high-value software revenue. If we used a 10 PS ratio, which is on the low end of what we used earlier when valuing out to 2031, we would get a $48.7 billion business, a 25x gain, and a 38% CAGR. If we used a 30% profit margin and a 30 PE ratio, which are similarly on the low end of what we used earlier, we would get a $43.83 billion business, which is a 22.6x gain and a 36% CAGR over the next 10 years. These would clearly be massive returns that I would be very happy with, that even still do not include any contributions from any new geographies, especially Asia, or any contribution from the commercial business. This is why I think the risk is well worth the potential reward. Now for my projections. First, for 2025, the average range implied by the first two valuations with the PE and PS ratio we did is between $7.7 and $11.6 billion, which would be a stock price between $52 and $80, which would of course both be great returns over the next 4 years. My price target I'll place on the lower end of this range at $60 a share by 2025, which would be a 46% CAGR over the next 4 years. For my 2031 price target, the average valuation range from all three methods is between $30 and $42 billion, which would put the stock price between $210 and $285 a share. These will both be crazy returns over a 10-year time horizon, both well over 10x. And again, I'll put my price target at the lower end of this range at $225 a share in 2031. These returns will be awesome, and that's what makes this risk, which is large for a company like Latch, well worth the potential reward. Finally, for my conclusions. The most important thing, as always, is the underlying business, and I have high confidence in Latch. As I went through the process of making these projections, they came out way higher than I was previously thinking, which was a pleasant surprise. Keep in mind that these valuations do not include any benefits from the hardware business, which they are thinking will be profitable on a unit basis starting this year, as well as no benefits from the commercial business or from any entrance into any other markets around the world, Asia in particular, of course. Of course, there's still a lot of risk with Latch, and they are a very young company in the beginning of their growth with a huge market to go into that will require a lot of excellent execution to take advantage of, and I think this should be factored into any analysis. As for me, I'm just holding my position in Latch as I built it up to where I'm comfortable with at about 2.1% of my portfolio. However, I would add aggressively if it went back to or below the $10 range. Finally, for more on Latch, check out my first video on them that will be the first link in the description. Thanks for watching. What do you think of Latch? What is your price target? What do you think of my evaluation? Let me know in the comments below. Don't forget to like and subscribe. It really helps out the channel. My goal is to reach 1,000 subscribers as soon as possible, and I'd love to have you along for the ride. Thanks again for watching, and have a great rest of your day.